Hello and welcome to Kitco Mining's Digging Deep, sponsored by Revival Gold, with me, Paul Harrison, coming to you from the 2024 Precious Metals Summit in Beaver Creek in Colorado. Joining me here today with our dueling laptops is David Erfle, founder of the Junior Miner Junkie newsletter. David, welcome back to Kitco.
Thanks, Paul. Always great talking to you.
Excellent. Now, we hope you like what you see, so please hit that subscribe button. But also note that Digging Deep is not investment advice. The opinions expressed here are our own and not Kitco's. David, we're at the 2024 Precious Metals Summit in Beaver Creek, Colorado. We're going to talk a lot more about this and your impressions of the event a little bit later on, but we have to do the news first, and what a week we have for news. Anglogold Ashanti announced it will buy London-listed gold miner Centamin for £1.9 billion in a cash and share deal with a 37.6% premium. Centamin operates Sukari in Egypt that produced 450,000 ounces of gold last year. It's also developing the Doropo Gold project in Côte d'Ivoire, which recently completed a feasibility for a 167,000 ounce per year operation. Anglo has been moving out of Africa and into North America, and has even moved its headquarters from South Africa to Denver. So David, is it a surprise for you that it's now bought other properties in Africa?
Not really, Paul, because Centamin is undervalued to peers, and it boasts one of the largest gold mines in the world in the Sukari mine. I mean, in the first 2 months of the third quarter of this year alone, the mine reported production of over 93,000 ounces and sales of over 102,000 ounces at an average realized gold price of $2,420 an ounce. And as you recall, in December of 2019, Centamin rejected a 1.5 billion pound all stock takeover proposal from African gold miner Endeavour Mining, saying it did not offer enough value to Centamin shareholders. But although the Anglogold offer is a 30% premium to the Endeavour offer of 5 years ago, the gold price is 65% higher now than it was in 2019. So that means margins at the Sukari mine have increased significantly since then as well.
Do you think there will be a competitive bid, a competing offer?
I would not rule out Endeavour making another offer. I mean, in a bidding war for Centamin would also be a big positive for the sector.
Now, Anglogold Ashanti's share price is up about 60% year to date. Centamin's only 20%. So Anglo is potentially getting some really good leverage by using its paper in this deal. Do you think we will start to see other producers potentially doing similar things?
Yeah, that's a great point, Paul. I mean, with so many undervalued late-stage developers, the strategy may also be being discussed right now farther down the sector food chain here at Beaver Creek and at Denver Gold Forum later next week. There are several high-flying mid-tier miners that could use their higher valued stock to make accretive acquisitions of a depressed late-stage junior.
Okay, what a summer for M&A. BHP with Filo, Goldfields with Osisko Mining, First Majestic Silver with Gato Silver, and now, as mentioned, Anglogold Ashanti with Centamin. David, I guess two-part question here. Do you expect more M&A to come? And also, with some of the cash that these deals is going to release, to what extent or not do you think that will be recycled back into the sector?
Yeah, absolutely. More. I mean, we've seen M&A heat up as the gold price has remained over 2,500. And as we're talking now, I think it hit another all-time high today. So, and with the Goldfields deal being an all-cash offer from a company already controlling 50% of Osisko Mining stock, we already saw OSK shareholders rotate their profit into near-term takeover candidate late-stage juniors on the very day that deal was announced. I mean, there was several quality developer stocks printing double-digit gains in mid-August on August 12th on the day that deal was announced.
And as Warren Owen, who I interviewed earlier, you'll be able to see the video on our YouTube channel. As he mentioned earlier, some of these deals also release management teams to perhaps get up and go and do it again, find something else, find another asset to do it again.
Absolutely. Yeah, I mean, with G Mining's newly acquired Oko West project bordering G2 Goldfields' Oko project, a combined project would boast 2 million ounces of gold from two deposits with a combination of open pit and underground with blue sky potential. So this is another deal that's crying to be made possibly in the future. I know they just took out Reunion to acquire that project, so maybe not in the near future, but an eventual G Mining takeover of G2 Goldfields would fit the company's plan to become the next mid-tier gold producer.
Okay, that's a transaction that's, you could argue, is screaming out to happen. Now, let's be a bit more theoretical here. If you could put two companies together, two assets together, anywhere in the world, what two would they be?
Well, those two. That's the one I just mentioned. I mean, that's the one that's crying out to happen now that G Mining took over Reunion, that Oko project. They border each other, and that needs to be a standalone project.
Okay. Well, one thing I think could be interesting would be if gold developer Artemis Gold, that's bringing online the Blackwater mine in British Columbia, made a bid for New Gold, the company it bought it from. New Gold's a producer, of course. Artemis, their market capitalization is about 26% higher than New Gold's at the moment. And if they get an up rate as and when Blackwater comes into production, that could potentially be an interesting scenario. Anyway, more M&A as Newmont has agreed to sell its Telfer, Havieron and other interests in Australia to Greatland Gold for up to $475 million. David, it seems that the market has suddenly woken up. Why do you think that is?
Well, with the gold price continuing to hover around $2,500 an ounce, miner margins have increased significantly while posting back-to-back blowout quarters, which has taken their share prices higher and provided them more cash. This in turn affords major gold miners to make attractive offers for undervalued juniors or a smaller cap mine.
Okay, we have a lot more to come, but first, a quick word about our sponsor, Revival Gold.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
Welcome back. We have two massive PEAs out this week, and both of them are tied to recent M&A transaction. First off, Kinross Gold released a preliminary economic assessment for its Great Bear Gold project in the Red Lake District in Ontario in Canada, outlining production of 431,000 ounces a year at an all-in sustaining cost of about $800 per ounce, following an initial capital development investment of $1.2 billion with $250 million more in capitalized mine development prior to commercial production. The market thought Kinross overpaid for Great Bear Resources in 2022, particularly when the company produced an initial resource estimate, which, fair to say, underwhelmed the market. The market seems to have liked this announcement, though, giving Kinross a 5 to 6% lift on the day the PEA came out. David, what are your thoughts on the PEA?
Yeah, well, being a Kinross shareholder in my retirement account, I'm relieved to see a solid PEA for that project. I think CEO Paul Rawlinson told investors and analysts on a conference call the company sees potential to support a multi-decade asset there as well. I mean, that's why they bought it in the first place. So, and as you touched upon, it was believed earlier that Kinross may have overpaid for Great Bear. The market had assumed they paid around $200 per in-ground ounce for a project without a defined resource. They had to define the resource later, and then once they did, the market realized they ended up paying roughly $350 per in-ground resource after publishing the initial resource estimate, which was considerably less than the market had initially anticipated. And remember, Paul, Kinross was the company that paid over $1,000 an ounce in gold ounce in the ground when taking over Redback Mining in mid-2010, near the peak of the last gold miner bull market. And back then, the gold price was trading near $1,800. So 14 years later, here we are with the gold price trading well above $2,500 an ounce, while late-stage juniors de-risking multi-million ounce deposits are trading at an average of $40 an ounce in the ground. This is why I feel it pays to remain patient in the junior sector right now.
Okay, another couple of data points from that PEA. The net present value at a $1,900 base price for gold is $1.9 billion with an IRR, an internal rate of return, of 24.3%. These jump up to $3.3 billion and 35.5% 0.5% at $2,500 per ounce gold. David, some very good talk to the gold price there.
Oh, absolutely. And with the very real possibility of the gold price moving to $5,000 per ounce by the time the mine is expected to be in commercial production by 2027, the margins on this project are going to be fantastic if the gold price indeed doubles by that time.
Now, before Kinross bought the asset, there was a lot of speculation that Barrick Gold was in the room to buy it. Barrick did several due diligence site visits, would kick the tires very, very hard, but in the end, didn't pull the trigger on a transaction there. Do you think it will rue that missed opportunity?
Maybe so, Paul. I mean, the Barrick journey has been a really interesting one since the gold price broke out of a huge base below $1,400 in 2019. Just 6 years ago, Barrick was the largest gold producer after kicking off what has become a procession of major gold miner mergers and acquisitions, which began with Barrick taking over South African miner Randgold and also inheriting its CEO, Mark Bristow, in September of 2018. Then in March of 2019, Barrick abandoned an $18 billion plan to take over what was then number 2 gold miner Newmont. And then they instead merged their Nevada gold assets into a single company operated by Barrick. That was followed by Newmont buying Goldcorp in a $10 billion all-stock deal to become the world's largest gold producer, dropping Barrick down to number 2. Now recently, Barrick has dropped to number 3 after Agnico Eagle became the number 2 gold miner earlier this year. And if the Anglogold Centamin deal goes through, Anglogold will become the 4th largest gold miner, hot on the heels of Barrick. So I don't know how much longer Bristow can hold out before making an accretive acquisition to keep up with the major Joneses.
Now we have the Gold Forum in Colorado Springs next year, where the big companies exhibit their wares. It'll be interesting to see what feedback comes out of that. Other PEA action this past week, G Mining Ventures announced the PEA for the development of the Oko West gold project in Guyana that you mentioned earlier, David, which it acquired earlier this year through the acquisition of Reunion Gold. This outlines an open pit and underground mining and milling operation to produce 353,000 ounces a year of gold at an estimated all-in sustaining cost of $986 per ounce, following an initial capital investment of $936 million. G Mining Ventures recently announced commercial production at its Tocantinzinho gold mine development in Pará in Brazil, which will produce 174,000 ounces per year. It also just did a deal on another project in Brazil with BHP for just a royalty. David, G Mining seems to be one of the most exciting go-getting companies in the gold space at the moment.
Yeah, I couldn't agree more. I mean, G Mining's on a fast track to become the next mid-tier gold producer, like I mentioned before. I think that eventual G2 Goldfields deal will probably take place.
Now, it's not all good news in the gold space this week. Ascot Resources, their share price crashed after it said it will suspend operations at its premier development in British Columbia to focus on mine development and it is not mining enough ore to keep its mill running. David, it's tough being a single asset developer.
Absolutely. Unfortunately, it is. I mean, after the unfortunate heap leach accident in Yukon took a single asset producer Victoria Gold into receivership last week, Ascot has been forced to shut down its massively under-budgeted mine just 5 months after pouring first gold. Imagine being one of the unfortunate investors participating in the July 34 million bought deal finance at 43 cents and not being able to sell the shares until the 4-month holding period comes off by late November as you watch the stock fishing line down to 16 cents. Moreover, the company has stated that there is no certainty that they'll be able to raise the funds required to complete the necessary mine development work and to restart operations after the mine's been placed on care and maintenance already. So by the time the holding period comes off of the shares for the people that participated in the 34 million bought deal on November 27th, Ascot itself may be in receivership. I mean, we could see lawsuits over this one, Paul.
Now, this has echoes of what happened with Pure Gold and its Madsen mine development a couple of years ago. It didn't have enough faces to fill the mill, went into capital and liquidity issues. Eventually, it basically went bankrupt, and West Red Lake Gold Mines bought it for $6.5 million, if I remember correctly. So is this potentially another target for West Red Lake?
Oh, you never know. You never know what Frank's got up his sleeve.
True enough. Let's talk about the Precious Metal Summit, where we are and where we have been the past few days. Gold is at $2,500 per ounce. Well, more than that now. It doesn't seem to be any joy here. David, have you seen any smiles?
I have. I mean, I've spoken with several happy management teams the past few days that have been de-risking large, high-margin, late-stage projects and are enjoying their respective share prices bifurcating from the sector. It's almost like it's two sectors. And fortunately for JMJ subscribers and myself, we've gotten into several of these quality juniors early.
Well, what's been your best meeting so far?
I'd say Probe Gold. I mean, it's a company my subscribers and I have been shareholders in since April of 2020. And after announcing a fantastic updated MRE, which increased the resource by 131% to 10 million ounces in a high-profile gold camp in Val d'Or, in its Novador project, the stock has gone from a 52-week low to a 52-week high in just 3 weeks. I mean, this is the kind of torque in the share price of quality juniors we will see more of when generalist investors finally come back into this tiny sector after leaving over a decade ago.
Now, the Val d'Or district in the Abitibi, a very, very famous gold district. What's your view on how things are going to play out there? Because you've got Agnico Eagle Mines with a very much a cornerstone position there, centered around one of the biggest mines of Canadian Malartic there. You've got O3 Mining, a developer that's done a lot of consolidating over the years, got a lot of ounces there. Then, as you mentioned, you've got Probe that's also done some consolidation and got a lot of ounces. What's the end game in that district?
Yeah, I mean, in full disclosure, I own shares in both O3 Mining and Probe because I feel that they eventually need to merge. And now, since Probe has announced this 10 million ounce resource, if they merged, that would be 14 million ounces, and it also would be a more attractive takeover target for Agnico Eagle.
Okay, or is there any potential for another company to come in there?
Yeah, absolutely. We have Goldfields now that took over a Cisco Mining, so we got another player in the district. When we have more than one player in the district, we got bidding war potential going on.
And they prior to that, they bid for the half of Canadian Malartic via a bid for Yamana Gold.
Right, and Eldorado's in the district too.
Okay, lots of potential activity there. Any potential additions to your watch list from what you've seen here?
Well, this is kind of privileged information for junior miner junkie subscribers. I could tell you that I'm adding 2 copper developers, but I can't give you any details on that.
Fair enough. Now, how do you think the rest of the year is going to play out in the gold space, David?
Well, I see the gold price possibly being $3,000 an ounce by Q1. By the time we talk again at PDAC, I wouldn't be surprised for the gold price to be around $3,000 an ounce. I mean, you've got an election that is very chaotic. That neither side, I don't expect either side to expect to agree with the result, and it's getting very polarized in the U.S. And you've got the debt situation now to where you have a U.S. national debt of over $35 trillion and total debt with unfunded liabilities of over $107 trillion. I mean, it goes up $2.6 trillion a day. Neither of these candidates talk about because there's nothing they can do about it. There's no intention to pay any of it off. So it's just a spiral of debt. So the gold price is feeding off of that. And you have war drums beating all over the place. I mean, that's the last reason why I want to see the gold price go up, but it is what it is. The initial cup and handle target of the 13-year breakout in the gold price above 2,100 is $3,000 an ounce. But I think once we see the gold price reach its inflation-adjusted high, which would be a 45-year breakout if it gets to 2,700, because when gold price hit $850 an ounce in January of 1980, the gold price is yet to reach that CPI inflation-adjusted price, which is right around 2,700. I mean, we already have margins increasing significantly since the gold price broke out above 2,100. We've got the gold oil ratio going up. That helps margins. We got the gold CRB index. That's a proxy for mining costs. That's going higher. So once we have the gold price reaching its inflation-adjusted high and breaking out of a 45-year 45-year top. So that would be huge. And I think that will finally get the juices flowing in the juniors, trickling down from the majors that are already doing well and the mid-tiers.
I think one thing that's been interesting to see today, gold's hit that record 25.50 level. We've seen 5 or 10% gains in stocks across the board from major producers, mid-tier producers, small producers, explorers, silver companies. So I guess the question is that going to continue?
I think so. You know, the Fed's about to lower rates. I mean, that's priced in. So I wouldn't be surprised if we see a sell the news correction in the gold price before it starts to take off again, and that would actually be healthy. But absolutely, I mean, it needs to trickle on down. These majors have healthy balance sheets now. They've got excess cash. They're already paying dividends. They're doing stock buyback programs. They're going to have to start replacing ounces, and they're starting already because the M&A has heated up. It's heated up as the gold price has gone above 2,500.
Well, it sounds like we're going to have lots more to talk about in future editions of Digging Deep. David Erfle, thank you very much for joining us today.
Thank you, Paul.
And I'm Paul Harris, and this is Kitco Mining.